Welcome to Taking Stock for the week ending 19th of September 2025. My name is Jason Yin, and joining me today is my colleague Charlie Song. Now, before we dive into any of today's discussions, Charlie, just a quick reminder that the information we provide today is of a general nature and should not be considered personal advice. Markets are obviously always evolving, and past performance is not a reliable indicator of future outcomes. Well, Charlie, it's been another eventful week in the markets with central banks back in focus. The US Federal Reserve lowered their benchmark interest rate by a quarter of a percentage point this week and penciled in two more reductions before year end. And Chairman Jerome Powell made it pretty clear. The decision was driven by the growing weakness in the labor market, and also job openings were falling and unemployment is also inching up as well. And that's what's forced the Fed's decision for this.
That's right, Jace. And we're seeing some parallels here in Australia. The August jobs data showed total unemployment unexpectedly falling by 5,400 after a solid gain the previous month. The unemployment rate has held steady at 4.2%, but under the surface, full-time jobs dropped by nearly 41,000, while part-time roles increased.
Yeah, and that matters quite a bit, Charlie, because the softening jobs market is a pretty clear driver of monetary policy. Now, the Reserve Bank has already cut rates to around 3.6%, and markets are pricing in at least one more rate cut by year end. So, much like the Fed, the RBA is reacting to cracks that are starting to emerge in the labor market after an extended period of resilience.
Yeah, and the picture is quite consistent. Central banks are moving from holding the line on inflation to defending growth and unemployment.
Hmm.
That pivot has big implications for equities, housing, and currencies in both the US and Australia. And speaking of equities, one of the week's biggest movers was Tesla.
Yeah, that's right, Charlie. Tesla's share price jumped after Elon Musk purchased $1 billion worth of stock, which represents his first open market purchase since February 2020.
It's a pretty strong signal of confidence. We often talk about the founder effect when a visionary founder not only leads the business but has real skin in the game.
Mm.
Musk already fields a pretty big stake, but this incremental purchase matters. It tells investors that he believes in Tesla and it will be able to evolve its business model beyond electric vehicles into AI and robotics.
Yeah, that's right, Charlie. But there are some worries or concerns about the valuation. I mean, Tesla trades at elevated multiples compared to other tech giants, but history shows that when capital is committed to transformative technologies, for example, like you mentioned, AI, automation, and robotics, bubbles or not, long-term winners can often emerge. And Musk's purchase often reinforces this narrative that even if it doesn't calm investors' concerns about his political or even some of his governance style.
Yeah. And back to Australia, the XRG consortium has formally pulled its bid for Santos, with regulatory hurdles and valuation disagreements proving too difficult to overcome in what would have been the largest cash takeover in Australian corporate history.
That's right, Charlie. Santos shares fell back towards its pre-bid levels at around $6.65, though not materially below this figure. Interestingly, though, Charlie, post XRG's exit, Santos is now trading at around the same level that Woodside was, and this raises question about relative valuation within the energy sector here in Australia. So if Santos dips materially below the $6.65 level, we think investors could see a bit of renewed value coming into the stock.
Yeah, and one of our star growth and star income stocks, Super Retail Group, also hit the headlines this week. The board has moved to terminate the employment of Managing Director Anthony Harady. This relates to his relationship with the company's former Chief Human Resources Officer. The board concluded Mr. Harady's prior disclosures were not satisfactory.
Yeah, this is a bit disappointing. I mean, given the fact that you and I, Charlie, we met with Supercheap's management team probably a couple of weeks ago, and it's a little bit surprising, I guess, on our end that Mr. Harady's exit was so, I guess, immediate. His CFO, David Burns, will be stepping in as interim CEO, and there is obviously going to be a search for a permanent replacement as well. I mean, invariably, this does create a little bit of short-term operational disruption, but we think the company remains rather comfortable. Their competitive position remains pretty solid, and they should be able to generate, I guess, sustainable value over time.
Yeah. And finally, a new star stock initiation. We've added Sandfire resources to our star growth stock universe. Sandfire is a pure play copper producer with operations in Spain, Botswana, and the USA. It mines, processes, and sells copper concentrate with zinc, silver, and lead byproducts.
Yeah, copper has been a pretty attractive metal. And this has come, I guess, on the back of the world's shift towards electrification, also decarbonization as well. Think electric vehicles, wind turbines, and also modern energy infrastructure networks as well. So Sandfire isn't the largest player in the space, but management have proven their operational ability, especially with the $800 million Mothio copper mine that they're currently building in Botswana.
Yeah, and we're comfortable with the balance sheet. The company
Mm,
is de-gearing towards net cash by FY26, but investors should remember copper is cyclical,
mm.
and Sandfire's production profile in the medium term is not particularly clear. Exploration success in the Iberian Pyrite and the Kalahari copper belts will be critical for long-term production growth. We also flagged the longer-term risk of technological substitution reducing copper demand. In Under the Microscope this week, we take a closer look at XRF Scientific. That's a company we've just initiated coverage on as a star growth stock. Jace, you are covering the analyst on this stock. Can you please give us a quick background on what the company does?
Well, XRF is a Perth-based manufacturer of precision testing equipment, platinum labware, and also chemical consumables that are critical in the material sampling testing space. Its instruments and fluxes are used widely across the mining and industrial lab sector. The company has roughly 50% of the global market share in fusion flux consumables, which is a niche but crucial product for preparing samples in X-ray fluorescent sampling.
Wow, and its client list includes some of the biggest miners, BHP and Rio Tinto, plus leading testing labs like ALS and Intertek. Their crushers are also deployed in gold testing labs, giving them diversified commodity exposure beyond iron ore into base metals and rare earths.
Yes, that's right. So they are pretty broad across most metals. From a growth standpoint, the FY25 figures saw pretty strong growth in sales across equipment and also consumables, and we expect demand to remain rather firm given exploration activity and global investment within the energy and also transition metal space as well. Importantly, we had visited the company's Melbourne Precious Metals Lab back at the end of 2023. At that point in time, due to liquidity constraints, we held back coverage of the stock. Positively, average daily traded has now hovered around $500,000. So therefore, liquidity is positive, but remains rather limited for some investors.
Yeah, and that's a bit of a key risk. Price discovery is a little thin with only
Mm.
one broker covering the stock. So while the fundamentals are attractive, investors need to be mindful of execution and liquidity risks. For our question of the week, let's talk bubbles. There's a perception that markets are constantly on the brink of collapse, with many retail investors convinced the odds of a crash in the next 6 months are somewhere between 10 and 20%.
And also, research highlighted in the Wall Street Journal this month, Charlie, shows that bubbles are actually far less common than many fear. Looking back across 2 centuries worth of data, instances where stock prices doubled and then gave it all back within 5 years happened in less than 0.5% of all periods studied. In other words, they make headlines because they're dramatic, but they're pretty rare events. The chart on screen highlights in red the instances of a market correction and also the investor perception of crash probability.
And even when they do occur, they're not always purely destructive. Bubbles often leave behind lasting innovations. The railway mania of the 1800s built the infrastructure for industrialization. The radio and electronics boom of the 1920s laid the foundations for modern day mass communication. The dot-com bubble created the digital plumbing that powers today's internet. And now the AI surge may ultimately reshape industries, even if valuations get ahead of themselves in the near term.
Exactly, Charlie. What investors often miss is that between those occasional busts, markets spend the vast majority of its time compounding pretty quietly. Since the 1900s, a diversified global equity portfolio has returned around 9 to 10% annually. And this is even adjusting for world wars, depressions, and also some of the biggest crashes that we've had in history.
Yeah, Jason, it seems to me the key takeaway isn't to spend time trying to guess the next bubble or crash.
Hmm.
Instead, it's about positioning, holding a diversified portfolio, and avoiding being overexposed to the hype of the moment. And let time in the market work in your favor. History suggests bubbles aren't the norm, steady gains are.
And I think that's a pretty good note to finish on, Charlie. Markets are always volatile and has always been, which is why it pays to stay diversified and also stay disciplined as well. Thank you so much for your insights, Charlie. I think we had a really productive discussion today.
Yeah, it was great to be here with you, Jason.
For our members, don't forget to tune in every Monday for Lincoln Live, where the team unpacks the latest market moves and what they mean for your portfolio. That's all from us this week. Thank you so much for watching, and we'll see you in the next episode.